Hey there, and welcome to this explainer. Look, are you completely sick of opening your broker's app and feeling like you need an espresso IV drip and, I don't know, a shouting headset just to buy a simple ETF? Well, trust me, you are absolutely not alone. Today, we're demystifying order types for the long-term investor. We're going to learn exactly how to navigate those super intimidating screens with total confidence, and most importantly, without accidentally turning into a chronically anxious day trader. Okay, let's dive right into this. So, here's our quick roadmap for stripping the chaos right out of your stock market experience today. We're looking at the overthinking investor trap, market versus limit orders, the danger of stop orders, time and force and recurring buys, building your safe system, and we'll wrap up with your anti-trader rule. All right, kicking things off with Section 1, the overthinking investor trap. Let's be real for a second. Modern broker interfaces? They can be incredibly intimidating for beginners. I mean, they're literally built to encourage constant trading, right? Flashing numbers, complex drop-down menus. It's a lot. But remember, we're here to build a calm investing system. Let me tell you the cautionary tale of Ben. Now, Ben was doing great, perfectly fine, until he discovered his broker's advanced order type menu. Suddenly, day 1, he finds all these shiny buttons. Day 2, he decides to set a trailing stop loss, thinking, hey, I'm protecting my downside, just like the pros do on the internet. Well, Day 5 rolls around, the market takes a tiny, totally normal dip, but boom, it triggers his stop and automatically sells his ETF. Then Day 12, the market completely recovers. So what happens? Ben is forced to buy back his shares at a higher price. Without meaning to, he accidentally turned his boring winning strategy into this incredibly stressful video game of selling low and buying high. So how do we make sure we don't end up like Ben? Let's take a breath and think about this brilliant analogy. Think of order types like seatbelts. You need them, but you don't win races because you have the fanciest seatbelt. Tools do not create successful strategies all by themselves. They really just make execution easier when you use them correctly. Moving right along to Section 2, market versus limit orders. To keep things simple and keep you on the right track, we're completely stripping away the unneeded complexity today. We're just going to focus on the 2 basic safety instructions you actually need to know. And this perfectly illustrates the fundamental trade-off we're dealing with here. A market order prioritizes immediate execution speed over price. You're essentially shouting at your broker, just get it done right now. A limit order, on the flip side, prioritizes strict price control over execution speed. With this one, you're saying, I will only buy at this specific price or better. So it's really guaranteed fill versus guaranteed price. Let's look a little closer at market orders first. Like I said, they execute immediately at whatever the best available price is on the exchange right then. Honestly, for pure simplicity and speed, they're perfect for small, routine purchases. They're also great if you're buying highly liquid, broad ETFs where the price doesn't really jump around like crazy. However, and this is a big however, because they lack any specific price guarantee, they can actually become pretty dangerous outside of normal market conditions. Like, say, during crazy high volatility right at the opening bell, or if you're buying thinly traded ETFs that have really wide bid-ask spreads. And by that, I just mean a large gap between what buyers want to pay and what sellers actually want to charge. And then we have limit orders. These tell the broker to buy only at or below your target price. This gives you ultimate control. It absolutely slashes the risk of overpaying, making it the ideal choice for larger purchases or for those ETFs with wider spreads where you definitely don't want any nasty surprises. But there is a catch for beginners. If you set your limit price way too strict and the market moves away quickly, your order might just sit there. It might never execute, leaving your cash just totally idle. Which brings us to Section 3, the danger of stop orders. Okay, listen up, because I need to issue a serious warning about a feature that gets heavily promoted by day traders, but one that can literally devastate a long-term portfolio. So by definition, a stop order is a trigger instruction. It automatically converts into a market order to sell if the asset's price drops to a specified level. Now, I know what you're thinking. That sounds amazing, right? Like this highly protective automatic parachute for your money. But actually, for our buy and hold strategy, it is incredibly dangerous. It's honestly fascinating how the actual reality completely debunks the common trader myths that lures so many beginners in. I mean, you might believe stop-loss orders protect you from massive market crashes. But the painful reality? They frequently trigger during perfectly normal everyday market volatility. They literally force you to sell and lock in permanent losses. Or you might think stop limits give you perfect control. But in a genuinely fast market drop, prices can gap down, entirely skip your limit price, and leave you holding the bag thinking you are perfectly safe. Always remember, order types are just execution tools. They are not some magical performance strategy designed to beat the market. All right, on to section 4, time in force and recurring buys. So let's look at the actual settings that let us step away from staring at charts and let our long-term strategy run on autopilot. When you place a limit order, you have to choose a time in force. A day order is, well, exactly what it sounds like. It safely expires at the end of the trading day. If it doesn't fill, done. A good till canceled or GTC order stays active for anywhere from 30 to 90 days, depending on your broker. For beginners, I strongly recommend sticking with the day setting. Honestly, GTC orders act like potential financial landmines. They're basically these easily forgotten limit orders that can just randomly execute weeks later, long after market conditions have drastically changed against you. But hey, do you want to know the absolute best possible tool at your disposal? The real holy grail for long-term investors? Recurring automatic orders. It perfectly enforces discipline, it bakes dollar cost averaging right into your system, and best of all, it completely removes the emotion of market timing. You literally just set the amount, pick the schedule, and let the broker do the heavy lifting while you, well, go live your actual life. Let's put this into practice. Section 5, building your safe system. The crucial step now is moving from all this theory to practical application by establishing some really robust habits. I absolutely love this simple self-diagnostic tool. It's great for helping you figure out if you're slipping from calm investing into, anxious amateur trading. So if you're using simple execution and just investing on your set schedule, that's a huge green flag. Keep going. Now, if you're feeling tempted to perfectly optimize your entry points, maybe checking the charts in the middle of the day, that's a yellow flag. Time to pause and review those long-term goals. But if you find yourself setting stop orders and trading frequently out of pure panic or fear, that is a massive red flag. You literally need to step away from the screen immediately. To help you get entirely comfortable, here are a few super simple broker mastery exercises you can literally do right now. First, take a minute to physically map out the order types your specific broker actually offers. Next, choose a default order type for your strategy and write it down. Just commit to it. And here is the best trick of all. Practice creating an order without hitting submit. Write down what you notice. Clicking around your broker's panel without the terrifying pressure of submitting a real trade is absolutely the best way to conquer screen anxiety and remove the whole mystery of the platform. Now, for those times when you absolutely do need to place a manual trade, here is your foolproof, safe limit order checklist. Step 1. Look at the current ask price of the ETF. This is simply the price sellers are currently requesting. Step 2. Set your limit price equal to or maybe slightly above that exact ask price. Step 3. Choose day for your time in force setting. That's it. Walking through this incredibly simple step-by-step template pretty much guarantees you get a fair price and immediate execution without having to agonize over pennies for hours on end. Finally, bringing it all home with Section 6, your anti-trader rule. Before we wrap up today, we really need to establish a psychological anchor, something that will keep you on track for decades and prevent you from getting sucked into all the financial noise. I want you to read this anti-trader rule with absolute conviction. Heck, write it on a sticky note and slap it on your monitor. My order types are tools, not entertainment. I do not place extra trades just to feel productive. I am an investor, not a trader. Always remember that simplicity is a core feature of successful investing. It is absolutely not a weakness. So I'm going to leave you with this final provocative question to chew on today. Does your default order type genuinely support your long-term wealth goals, or is it secretly feeding a stressful new hobby? Think about that. Set up your incredibly boring but incredibly effective system and then just log off. Thank you so much for hanging out with me on this explainer, and happy investing.